In this presentation, we will use tax software to consider the itemized deduction related to interest. The tax software we will be using is Lacert, owned by Intuit, the owner of QuickBooks. Other types of tax software will be similar in that you'll have the data input process and then the generation of the actual forms with it. We are on our Form 1040. We have the single individual, that being Tim Jones. We're going to scroll down. We only have the income of the $100,000 for the W-2 income at this time. We're currently taking the standard deduction. This is where our focus is going to be down here, line 9, which is either the standard deduction or itemized deduction. We're now going to be considering the interest, focusing in on mortgage interest on the Schedule A. This is one of those items that is often going to be one of the key components, if not the key component, that pushes most people over when they do itemize. In other words, if you're looking at someone that has an itemized deduction or does itemize as opposed to taking the standard deduction, it's often the mortgage interest that is a big component that is pushing them over the standard deduction, which in this case for a single individual is the $12,200. So whenever you're doing tax preparation, if you're doing your own return or someone else's, you want to think, does this person own their own home? If they do, they probably have a mortgage on it. If they have a mortgage on it, then you want to be considering the mortgage interest and thinking that that could be something that's going to push them over from itemizing. You also want to consider the fact that they'll have a home and probably have property taxes as well, which is a state tax, another item that could be pushing you over for itemizing the itemizing deductions. Now, the mortgage interest will typically be reported on something like a mortgage interest statement, the Form 1098. So a 1098 looks a lot like a 1099, but a 1099 is usually something that you think about would be affecting up top, up here in the income section, something that may be having to be reported as income. The 1098 is something that may be deductible. So big difference, even though it's a small change in the number there. 1098, now we're thinking, okay, this is like a good form. This could be a deduction type of form as opposed to a 1099 form, which usually means we're going to be paying more taxes because it's going to be something included in income. So it may not be formatted just like this, but this will be the type of form you will be receiving. If you have questions about any of these boxes within it, you can check the IRS website and look at the instructions. We'll also include them so that you can see what the instructions are per line item on the 1098. So let's go back into our forms and put some information in for the 1098. I'm going to go back into our deductions and we're going to take a look at the itemized deductions. We want the interest. So I'm going to go to the interest. Now, first line item, typically going to have the home mortgage interest and points that are reported on the 1098. So these would be items that are actually on the 1098, which is typically the case. However, if you have the new home purchase, it's possible that you want to look through the closing statement and you may have some points that aren't included on the 1098. Now, more and more they're getting good at including it on the 1098, but you may have some points that are not included, and then you'd have to deal with those items. So I'm going to say here that we have, let's say, $15,000 of interest. So on the 1098, if I go back up to the forms then, we're going to say now the standard deduction has been replaced by the itemized deduction on page 1 of the 1040. We're now at that $16,010. We now see that the Schedule A, the itemized deductions, has appeared at this point because it's something that we now need to file. Scrolling back up, this is going to be the Schedule C itemized deductions. We have the state taxes here being calculated by the system. So the state taxes are going to be calculated by the system. Scrolling back down, we have the interest that we have included. It's on line 8A of that $15,000 that we took from the Form 1098. Scrolling down, that gives us the $16,010. Just remember, we're not going to deal with the taxes right now because we talked about them before, but just remember, if you have mortgage interest on a home, you would think that you would have property taxes, which sometimes would also be included in the Form 1098, depending on how those mortgage interest payments are being made. But you always want to consider that whenever you see a interest on the home, you would automatically in your mind say, okay, we're itemizing, quite possibly itemizing, probably have mortgage interest that we have to deal with as well. Now, you still need a good amount of mortgage interest, though, because remember, this is just the interest. This isn't the actual home purchase price. This is not actually the loan amount. This is going to be the interest that had been paid for a year worth on the loan. If I go back up to the 1040 then, we see that we have the $16,010 Let's go ahead and change this now. If I change the filing status to married filing joint, so I'm going to go back over and we're going to go then to the client information. We're going to change this from a single status to married filing joint. Back over to the forms. Let's see what that then does. We're back to the 1040. We now have Tim and Ann, who are our happily married couple here. And we have the 100,000 still as the income. We now have between the standard and itemized deduction the 24,400, which is the standard deduction for the married filing joint. So notice it's still a fairly high threshold. Even if you have mortgage, interest, and property taxes, it would have to be, relatively high to get you over the married threshold, which is the 24,400, in order for it to be a beneficial thing. This has changed. Basically, last year was a change. These standard deductions are now higher. So even with the mortgage interest, it may be the case that some people are still taking the standard deduction. Now, if we then increase the mortgage interest a bit more, if I go back to the deductions and we then go to the itemized deductions, and I want to go to the interest, and I want to make this, let's say, 24,000. So 24,000 back to the forms then. We're now at 25,098. That's now taking the standard deduction as opposed to the itemized deduction, which is capped at the 24,400. We now see itemized deductions Schedule A appearing again, something that we need to file. This is going to be the Schedule A. We have the state taxes calculated by the system. 24,000 now has been included in the mortgage interest, and that adds up to the 25,098. Now, the other thing you want to be aware of is it's possible, oftentimes you have the mortgage interest that's going to be used to purchase the house or in order to have an improvement on the house. But you might have a situation where there's a loan taken on the house and it's for something that wasn't part of improvement. So someone took out a loan, used the home as collateral, but they didn't use the funds that they got for the loan for improvement of the house or the original purchase, but rather used it for something else, like buying a car or going on vacation or something like that. In that case, you'd have to check this box. So we have the home mortgage interest and points. If you didn't use all of the home mortgage loans to buy, build, or improve your home, see instructions and check this box. So in that case, you'd have to check this box, and you may not get a benefit in that situation, may not get the deduction in that situation.